After 3 committee reports and 5 years of pontification, the Government of India has finally moved to simplify foreign investment limits in the country. Finance Minister Arun Jaitley says FDI is now equal to FPI. Payaswini Upadhyay studies the implications, especially for protected sectors like banking, defence and retail.
To simplify further the procedures of Indian companies to attract foreign investment, I propose to do away with the distinction between different types of foreign investment, especially between foreign portfolio investment and foreign direct investment, and replace them with composite caps. The sectors which are already on a 100% automatic route would not be affected.
That announcement by Finance Minister Arun Jaitley will go a long way in deconfusing India's foreign investment policies. Currently, some sectors allow 100% foreign investment, portfolio or strategic, under the automatic route. In others, like banking, the total foreign investment limit is 74%, but portfolio investments are capped at 49%. While even in credit information companies, the overall limit is 74%, but portfolio investment is capped at 24%.
Let's say the total foreign investment limit was 49% or 74%. If the foreign portfolio investment was restricted to 23%, you would not have, even if FPIs were interested to invest further, you couldn't have invested further. And if the FDI investment was not available, then for that sector there was an artificial shortage created for foreign investment availability. So all of these issues would get dealt with if you remove the composite, if you provided a composite cap and remove the artificial distinction currently.
The intent is not to merge or collapse these windows, and as the Finance Minister had mentioned in the speech as well, that the concept of composite cap would apply to sectors where there is an FDI cap. And it's not a new concept. If you would see in sectors like telecom, broadcasting, and recently in defense and insurance, the principle of composite cap has been adopted, and the objective seems to be to bring simplicity in the way the foreign investment cap is to be calculated in sectors where there is either a conditionality or an approval requirement, or there's a limit on the foreign ownership.
There are some clear beneficiaries of this new announcement. In banking, for instance, the Axis Bank stock rose 8% the day after the budget on the promise that the portfolio investment limit for the sector will increase from the current 49% to the total foreign investment limit of 74%, giving portfolio investors more headroom to buy the company's shares. In the power exchange sector, the foreign investment limit is 49%, but FDI is capped at 26%, leaving FPI only 23% room.
Banking, there was currently a limit, even though total investment was allowed up to 74% foreign investment, that was restricted for the FPIs to 24% and then going up to 49% with board approval. And beyond that you couldn't go. So there was actually headroom available in most of the banks for further foreign investment. And now, with the removal of the restriction, the banking sector, the banks could go and get that investment through the FPI route.
But this effort to simplify foreign investment limits has also raised new complexities for sectors like multi-brand retail and pharmaceuticals. In both these sectors, foreign portfolio investors will be able to avail of only the automatic limits or the limit sans conditions.
There would be some sectors like, for example, brownfield pharma, which may not have a sectoral cap but have conditionalities. So how would the government keep in mind the fact that if an Indian pharma company is attracting more FII investments, say beyond like 26%, then will it really need to be complying with all those conditionalities which the government today mandates to comply where a foreign pharmaceutical company is making an acquisition? that would make it difficult for the Indian pharma companies to raise money on stock exchange, and that headroom will then come with some kind of a sacrifice. These are some of the aspects which the government may need to look into from a practical standpoint to make it more effective.
You take a sector like multi-brand retail. Today, multi-brand retail investment in multi-brand retail is allowed only subject to certain conditionalities, and therefore under the automatic route, multi-brand retail investment is 0%. Foreign investment in multi-brand retail can be zero only. However, under the general dispensation of Schedule 2, 24% FII investment can be permitted in listed multi-brand retail companies. So once they notify a composite cap, it will be essential for them to take one composite cap where the existing FII investment is not affected. So multi-brand retail is an example of a sector where there will be a straight implementation issue.
Matters are more complex for companies in the defense sector. Last year, the Modi government permitted foreign direct investment up to 49%, but with prior government approval. The policy did not allow FPI investment in companies holding a defense license. Existing portfolio investments were capped and fresh investments not permitted. If now a composite cap is allowed for defense, then it will open the door to fresh FPI investments, but only up to the automatic limit of 26%.
Defense, multi-brand retail and pharma. More clarity will emerge for these sectors once the budget announcement takes the shape of a detailed policy circular. The hope is that the action is in line with the intent of facilitating ease of doing business in India. In Mumbai, Payaswini Upadhyay. Well, that's the...